Not changing strategy frequently. One of the most destructive habits in investing is frequently changing strategy. While adaptation is important, constant shifts usually reflect emotional reactions rather than rational improvements. 1. Strategy drift and emotional decision-making. Investors often change strategies after a short period of underperformance, seeing others outperform. Market volatility. Consuming new financial content. Behavioral finance research shows that investors tend to chase recent performance, abandoning a plan at exactly the wrong time. As documented by Dalbar studies, commonly cited in investor behavior research, individual investors often underperform the very funds they invest in due to poor timing decisions. The problem is rarely the strategy itself. It is the inability to stick with it. 2. The cost of constant optimization. Frequent strategy changes create transaction costs, tax consequences, loss of compounding, increased stress. Compounding requires time. Every reset interrupts the process. Research from Vanguard Group consistently emphasizes that long-term discipline and low turnover are strongly correlated with better investor outcomes. 3. Recency bias and performance chasing. Psychologists like Daniel Kahneman explain that humans overweight recent events. When a strategy underperforms for months, it feels broken, even if it is functioning normally within its cycle. Markets move in cycles. Growth outperforms, then value. Large caps lead, then small caps. Domestic leads, then international. Changing strategy at every cycle peak guarantees buying high and selling low. 4. Lack of statistical sample size. Many investors judge a strategy based on 3 to 12 months of results. But statistically, short-term outcomes contain noise. Even strong strategies experience drawdowns. Random variance can dominate skill. Professional investors often evaluate performance over multi-year cycles, not quarters. 5. The identity problem. Frequent strategy changes often signal unclear identity. Are you a trader or a long-term investor? Are you momentum-driven or value-focused? Are you passive or active? As Howard Marks emphasizes, successful investing requires consistency between philosophy and behavior. If your strategy changes with your emotions, it is not a strategy, it is reaction. 6. Discipline as a competitive edge. Legendary investors, like Warren Buffett, have maintained remarkably consistent principles for decades. The edge is often not superior intelligence, but superior patience. Stability allows compounding to work, process improvement, emotional resilience. Conclusion. Not changing strategy frequently is not rigidity, it is strategic commitment. Refinement is healthy. Impulsive shifts are destructive. Long-term investing success often depends less on finding the perfect strategy and more on sticking to a sound one long enough for it to work.